Bubble or breakthrough? It's the defining question of our time, whispered in boardrooms, debated in coding forums, and shouted from the headlines of every major publication. That's the question every investor, builder, and curious onlooker is asking about AI right now. The sheer velocity of change is intoxicating. Fortunes are being minted overnight, and the promise of a radically new future feels tantalizingly close. But with that excitement comes a familiar, nagging sense of déjà vu. We've seen this movie before. The dot-com boom promised a new world. It was a time of unbridled optimism, where companies with .com in their name saw their valuations soar into the stratosphere, often with little more than a business plan sketched on a napkin. The mantra was, "Get big fast," and the fuel was venture capital, poured into anything that seemed to touch the new digital frontier. Then reminded us, gravity still exists. The crash was brutal and swift. Companies that were once darlings of the market vanished. The term burn rate entered the public lexicon not as a sign of growth, but as a death clock. The lesson was seared into a generation of investors. Hype is not a business model. So in 2026, is AI the new .com or something bigger? Is this a speculative frenzy destined for the same fate? Or are we witnessing the foundational layers of a technological revolution far more profound than the internet itself? Here's the hook. Both can be true. The AI story is not a simple binary. It's a complex, layered reality where a speculative bubble is inflating right alongside a genuine, world-altering technological breakthrough. The challenge isn't to decide it's a bubble, but to understand where the froth ends and the foundation begins. Let's first look at the bubble signals. And the parallels are impossible to ignore. In the late 90s, eyeballs were a metric. The more clicks a website got, the more valuable it was perceived to be, regardless of whether it generated a single dollar of profit. Today, it's tokens burned, parameters trained, GPUs shipped. These are the new vanity metrics, impressive numbers that signify activity, but not necessarily value. They measure the cost of running the machine, not the profit it generates. But speculation hasn't gone away. It has simply changed its vocabulary. You've got sky-high valuations for companies that are little more than a promising research paper and a charismatic founder. We're seeing funding rounds in the hundreds of millions for pre-product, pre-revenue startups. The fear of missing out, FOMO, is palpable, driving capital towards anything with AI in its name. We see companies with no defensible moat. Their product might be a thin wrapper around a major foundation model like GPT-4 or Claude. They have no proprietary data, no unique algorithm, and no sticky user base. Their entire business could be rendered obsolete by a single API update from a tech giant. And then there are the products that are demos with a press release. Slick, pre-rendered videos showcasing incredible capabilities that don't actually exist in a usable form. They generate headlines and drive stock prices, but when you look under the hood, the product is either fragile, unreliable, or simply not there. These are all classic bubble signals. The market is rewarding narrative over numbers, potential over profit. It's a dangerous game, and for many it will end in tears, just like it did in 2001. Now for the breakthrough side. This is where the comparison to the dot-com era begins to break down. Unlike the early internet, where revenue was often a distant dream, the AI stack is already throwing off real revenue, and lots of it. The picks and shovels of this gold rush are incredibly profitable. We're talking about chips, the specialized GPUs from companies like nvidia that are the bedrock of this entire revolution. We're talking about data centers, the massive, power-hungry warehouses that house these chips. And we're talking about power, the sheer electricity required to train and run these complex models. Moving up the stack, the foundation models themselves are generating billions in subscription and API revenue. And the vertical tools built on top, AI-powered software for specific industries like law, medicine, or finance, are creating tangible value and commanding premium prices. This isn't speculative ad revenue. It's cold, hard cash from businesses paying for tools that make them more efficient. Crucially, the underlying unit economics are improving at a blistering pace. Inference costs, The cost to run a query on a trained model are trending down. Latency, the delay between a request and a response, is shrinking, making real-time applications possible. And accuracy is going up, meaning the models are becoming more reliable and useful for mission-critical tasks. This is the engine of progress, and it's firing on all cylinders. Because of these improvements, AI agents are moving from novelty to workflow. This isn't about asking a chatbot to write a poem anymore. It's about automating customer support, where AI can resolve 80% of inquiries without human intervention. It's about coding, where tools like GitHub Copilot act as a tireless pair programmer, boosting developer productivity by over 50%. It's about scientific research, where AI can analyze massive datasets to discover new drug candidates or materials. It's even in logistics, optimizing supply chains in real time to save millions in fuel and time. That's not a banner ad in 1999. That's productivity you can measure. That's real economic value being created today, not in some distant future. This is the fundamental difference. The dot-com boom was built on the promise of future business models. The AI boom is being built on technology that is already delivering. If you're finding this helpful so far, drop a like. It really helps the channel grow and reach more people. Thanks for supporting the channel. So how do I separate froth from fundamentals? How do you, as an investor, an employee, or just an observer, navigate this dual reality? You need a framework, a reality check. Here are 5 critical questions to ask of any AI company. First, show me repeat usage, not just signups. A massive launch day is exciting, but it's a vanity metric. What matters is retention. Are users coming back day after day, week after week? Is the product becoming embedded in their daily workflow? High churn is the silent killer of software companies. Look for cohort curves that flatten out, not ones that dive to zero. Second, switching costs. If I can replace your product with a competitor in a single afternoon, it's not a moat, it's a feature. True value is created when a product becomes deeply integrated. Think about proprietary data formats, workflow integrations, or network effects that make leaving painful. If I can replace it in a day, it's not a business, it's a commodity. Third, distribution. Who owns the customer? It doesn't matter if you have the best model if you have no way to reach your users. Are you selling directly to customers and building a brand? Or are you just a feature in someone else's platform? The companies that own the end-user relationship, that own the channel to market, are the ones that will capture the most value in the long run. Fourth, margins. This is the big one. Are your compute and power costs trending down faster than your revenue per user? AI is expensive. If every new user costs you more in GPU time than they pay you, you have a hobby, not a business. You need to see a clear path to profitable unit economics. Show me the math that proves this scales. And fifth, regulation. The regulatory landscape for AI is still being written, but it's coming. Companies that treat privacy, security, and ethics as an afterthought will face massive headwinds. The winners will be compliance-ready. They will build trust by design. In this new era, move fast and break things is being replaced by move carefully and build trust. Move fast, break fines is not a sustainable strategy. So, are you worried about a bust? You should be. But you shouldn't be paralyzed by it. The key is to expect mini bubbles inside a megatrend. The entire forest won't burn down, but certain trees will fall. Some categories will pop. The thin wrappers built on someone else's API, the hype coins with no underlying utility, the endless stream of Me Too chatbots that offer no differentiation. These are the modern-day pets.coms. They will attract speculative capital, and they will get washed out in the first downturn. But the infrastructure, the chips, the power, the networking, the data pipelines, and the high ROI vertical apps that solve real expensive business problems, they will keep compounding. These are the Amazons and Googles of this era, the companies that will emerge from the rubble stronger than ever. If I were allocating capital today, I would diversify across the stack. Own the picks and shovels, the companies providing the fundamental building blocks. They win no matter which application comes out on top. And I would bet on teams with proven distribution and clear, boring unit economics. Look for the quiet compounders, not the loudest promoters. Find the businesses obsessed with customer acquisition cost and lifetime value, not the ones obsessed with their Twitter mentions. And most importantly, keep a long horizon, because platform shifts don't die when a bubble bursts. They consolidate. The weak players are flushed out. Talent and capital flow to the strong, and the true foundations of the next economy are laid. So, is AI the new .com? Yes. And no. It's the same human psychology of greed and fear, but applied to a technology with far more substance and immediate utility. The challenge, and the opportunity, is to see through the hype and focus on the value. Because the breakthrough is real, and it's just getting started. Every era has a turning point, and you're living in one. The world is changing fast, but the wise adapt faster. If this opened your eyes, hit like, drop a comment below, and subscribe to Think Too Rich, where truth meets wealth. Because the future doesn't wait for anyone. It rewards those who prepare.